Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here is your weekly technical analysis of LME 3-month lead and tin.
LME 3-month lead. In mid-September, the market started a move lower that eventually led to a September to October based bear channel, highlighted in dark blue on my daily chart. However, the low point of the move down, 4 weeks ago, at the January 2020 high at 2039, prices turned back up again with a combined daily key reversal up and bullish engulfing pattern. 4 weeks ago, I said, and I quote, "Only if we see the market stabilize at this January 2020 high at 2039, as it did back in early July, only then can we see prices possibly using this bear channel to move or even vault into the next pattern." And that's the end of the quote. Prices did indeed stabilize there and rode back up again to the upper bear channel line, and 3 weeks ago up through it to test, punch through and close over amongst many resistances: the flatlining long moving average, currently at 21.23, the 50% Fibonacci line, the March 2020 to March 2022 move at 21.35, the very slowly rising medium moving average, currently 21.43, the flatlining short medium moving average, currently 21.59, significant congestion at 21.86, and that's an important level, and finally the lower trendline extension, highlighted in bright red, of the May to June descending triangle, currently 21.92. It is at this point that I once again draw your attention to my commentary from 2 weeks ago when I said about the bear channel, and I quote, "This now gives me the opportunity of pointing out potential targets topside for a break of such a pattern. Thus we have a primary target X in the 2185 area, with a secondary hard to reach target X1 in the 2270 area." End of quote. As you can see from the recent action, prices reached the primary target X at 2185, even exceeded it a little, but could seemingly not punch up through the bright red trend line extension, and have rolled over lower from the middle of last week with a 3-day bearish advance block pattern. We are now testing the short medium moving average, but as support this time. The one outstanding question left is what this break higher from the upper trend line, what possible new pattern is in the offing. Will prices hesitate and continue higher, up towards the harder to reach target X1 in the 2270 area, or will it go sideways or down? The only thing I can add is that the October action was a V-bottom pattern with an extension. This is typically a bullish reversal pattern, and this is what we've happened here until now. I'm curious to see if the market has any more legs on it for the upside, or was the primary target enough? The next overhead resistances of note are a pair of 50% Fibonacci lines. One at 22.21 is from the June to October 2018 move, and the other at 22.25 is from the whole of the 2022's move. LME 3-month tin. The action from late July until the start of October, initially and for quite a while during its construction, looked like it might be the second leg to a bearish halfway hesitation, but prices ran into 2 significant supports that stopped the decline. The first support was, and is, an obvious one. It is a series of congestion bands seen below, specifically between 23.850 to 24.155 and between 22.895 and 23.555. I have spoken about these numerous times before, so they should be familiar. The second support was a newer, less obvious one, but one that still needed to be considered, even if not a perfect example of one. It is the June to October potential head and shoulders pattern, with specifically the neckline highlighted on my daily chart in bright red, currently at 23.070. As I've already said, this is by no means a good looking pattern, with the second shoulder having quite an extension on it, but even now it's still worth considering. These 2 supports caused a turnaround back up at the start of October, up through the resistances from the 50% Fibonacci line, the October 22 to February 2023 move up at 25.020, then the 2013 high at 25.250, and finally stopping and turning back down mid-October at the declining short medium moving average overhead, currently at 25.160. The decline from there over the last 4 and a bit weeks was initially cautious, but it eventually ended up 2 weeks ago just where we had been before. Two congestions between 23,850 to 24,115, and then between 23,555 to between 22,895 to 23,555, as well as the bright red neckline of the extended head and shoulders top. As one might expect, all these supports turned the market back up, yesterday piercing both the 50% Fibonacci line up at the 25,020 level and the declining short medium moving average, but crucially not closing over either. 2 weeks ago I voiced a controversial point. It was to regard this market as still being caught, at least right now, between the damaged but still working significant resistances overhead, in which I will also now include the declining long moving average, currently at 25,850, plus the slowly declining medium moving average, currently at 26,120, and the significant and previously highlighted supports below. Nothing has occurred this week that has changed that outlook, though yesterday's action did cause some closer scrutiny. So for now, I'll still stay with that idea.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.